When you hear the word accounting, what's the first thing that pops into your head? Probably spreadsheets, right? Taxes, maybe some really boring math. But what if that's not the whole picture? What if accounting isn't really about numbers at all? What if, at its heart, it's actually a language? The language that every single business speaks.
So let's just run with that idea for this whole explainer. Think about it. Every business out there, from the coffee shop on your corner to a huge tech company, is telling a story. And accounting? Well, that's just the language it uses to tell it.
And hey, don't just take my word for it. Look at how the official rule makers, the AICPA, define it. They don't call it a science. They call it an art. They don't talk about just calculating things. They talk about interpreting. So right from the get-go, the experts are telling us this is all about finding the meaning behind the numbers.
Okay, so if it's a language, how do you learn to speak it? Well, like any language you've ever learned, it has a basic structure. It has rules, a grammar, and a vocabulary. To understand the stories businesses are telling us, we've got to start with those fundamentals.
It's really that simple. You can't just pick up a novel in a language you don't know and expect to get the plot, right? You need to know how the sentences are built first. Accounting is exactly the same. We have to start with its grammar.
So these next few ideas, think of them as the unbreakable grammar rules of accounting. They're not suggestions, they're non-negotiable. And they exist for one crucial reason: to make sure that an investor in Tokyo and a business owner in Toronto are reading the exact same story from the same set of numbers. It's all about creating a shared foundation of trust.
First up, the business entity concept. This just means the business is its own legal person, totally separate from its owner. So if the owner dips into the cash register to buy groceries, that's not just taking money. It's a transaction between two separate entities. The company's bank account is not the owner's personal piggy bank. And honestly, this separation is the only way you can ever tell if the business itself is actually doing well.
Next is the money measurement concept. The rule here is dead simple. If you can't put a specific dollar or euro or yen value on it, it does not go into the accounting records. And this is fascinating because it means some of the most important things, like your team's amazing morale, or the genius of your lead designer, or even a brand new competitor. None of that shows up on the books. Sometimes what the language can't say is just as revealing as what it does.
And finally, we've got the continuity concept. Accountants always start with one big assumption, that the business is a going concern. That's just a fancy way of saying it's built to last, that it's not going to shut down tomorrow. And that assumption changes everything. It's why a company can list a huge factory at the price it originally paid for it, not what it could sell it for today. The whole story assumes you're in it for the long haul, not just trying to flip your assets for a quick buck.
All right, with those grammar rules down, we can move on to the vocabulary. And what's kind of mind-blowing is that the entire language of business is really built on just three core words: assets, liabilities, and equity.
It's really a simple idea. On one hand, you have assets. That's all the stuff the business owns that has value. You know, it's cash, it's computers, it's buildings. These are the tools it uses. On the other hand, you have liabilities. That's everything the business owes to other people. Bank loans, money due to suppliers, you name it. These are the claims that outsiders have on the business's stuff.
And those two words bring us to probably the most important sentence in the entire language of business, the accounting equation. All it says is that everything a business owns, its assets, has to equal the claims against those assets. And there are only two kinds of claims: what you owe to outsiders, your liabilities, and what's left over for the owner, which is the equity. That's it. It's a perfect sentence that always has to balance.
And that last piece of the puzzle, owner's equity, is basically the owner's true stake in the company. Here's a simple way to think about it. If you sold off all your assets and used that cash to pay back every single one of your liabilities, whatever was left in your hand, that is the equity. That's the owner's real slice of the pie.
So, we've got our grammar, we've got our vocabulary. Now what? How do we actually put it all together to, write the story? Well, that happens through what's called the accounting process, which turns all the day-to-day chaos into a clean, final narrative.
But first, we need to get one thing straight, and that's the difference between bookkeeping and accounting. Think of it this way. Bookkeeping is just the routine work of writing things down, recording every transaction, getting the facts straight. It's repetitive, but essential. Accounting, well, accounting starts where bookkeeping stops. It's the analytical part, the interpretation. To put it really simply, bookkeeping writes down the words, accounting tells you what the story means.
And that whole process has a name, the accounting cycle. It goes like this. First, you identify a transaction. Say you made a sale. Then you record that sale in a sort of daily diary, which is called a journal. After that, you classify it by copying that entry into a notebook for that specific topic, like a sales notebook. That's the ledger. Then, at the end of the month, you summarize all those notebooks into a few key reports. And finally, you communicate those reports, the finished story, to everyone who needs to read it.
But why? Why go through all that trouble? Who is this story even for? Turns out there's a pretty big audience, and every single one of them is reading this story to make some really important decisions.
And yeah, the audience is huge. You've got investors reading to decide if they should buy or sell stock. You've got creditors and banks reading to see if you're a good bet for a loan. You have management inside the company reading it to figure out how to steer the ship. The government is reading it to make sure it gets its fair share in taxes. And hey, even employees are reading it to see if the company is healthy and their job is safe.
So, after all this, I hope one thing is crystal clear. This idea that accounting is just about crunching numbers, it's just plain wrong. The numbers are just the ink. They're the raw material.
The real magic, the real art, is in the interpretation. It's about using this powerful, shared language to tell a business's true financial story. A story about where it's been, where it stands today, and maybe even a hint of where it's going next.
So I'll just leave you with this thought. You now know the basics. You have the grammar, you have the core vocabulary of the language of business. You can start to see the narrative hiding behind the numbers. The only question left is, what stories are you going to start to read?